What if you could glance at a company's financial statements and tell, fast, if it's the kind Warren Buffett loves? Everything here is based on Mary Buffett and David Clark's approach, educational only. Today we'll break down the income statement, balance sheet and cash flow, the Buffett way. Here's the roadmap, the big idea, the 3 statements, green flags, red flags, and a 1-page checklist. We'll keep this simple and actionable, faithful to the book's explanations. Let's start with the big idea Buffett looks for. Consistency, margins, low debt, and reliable cash flow. This equals a durable competitive advantage, the core of the book. Now we'll walk each statement in order, the story of profit, strength on the balance sheet, and the cash reality. First, the income statement. A durable advantage shows up as consistent earnings, attractive margins, low reliance on debt, and steady cash generation. Consistency, profits that don't swing wildly year to year. Strong margins, keep more of each sale as profit. Low debt, power to survive downturns without high interest costs. Cash generation, earnings that actually turn into cash to reinvest or return. Together, these traits make Buffett comfortable holding a business for decades. Next, read the income statement, the story of profit. We'll run through the key line items and what to watch for. Start at the top, revenue, and move down the page, checking margins and stability. The income statement tells the story of a company's profitability over a period. It starts with total sales and subtracts all costs to arrive at the final profit. Think of it as a performance report card, showing how effectively a business turns revenue into real earnings. The story begins with revenue, the top-line sales figure. We want to see a consistent upward trend over 5 years. From revenue, we immediately subtract the cost of goods sold, or COGS, the direct costs of making the product like raw materials and factory labor. What's left is gross profit. But the key metric is gross margin. That's gross profit divided by revenue. This percentage shows the core profitability of the company's products. Warren Buffett loves this number. A high and stable gross margin signals a strong competitive advantage, or moat, showing the company has pricing power. Next, we deduct operating expenses, the costs of running the business. This includes sales, general and admin costs like salaries and rent, plus research and development. A key green flag is when these expenses grow slower than revenue, showing the company is becoming more efficient as it scales. After all operating costs are out, we get operating income, or EBIT. This is a pure measure of the business's operational health, before factoring in debt and taxes. It's a crucial checkpoint. From operating income, we subtract interest expense. A high or rising interest cost is a yellow flag for too much debt. After paying taxes, we finally arrive at net income, the famous bottom line, the ultimate profit that belongs to shareholders. To understand shareholder value, we look at earnings per share, or EPS, net income divided by the number of shares. We want steady growth. Also, check the share count. A shrinking count from buybacks is a great sign of confidence. A rising count means dilution, a red flag. So the story we want is one of growing revenue, strong margins, and rising EPS. This tells us we've found a profitable business. Now that we've read the story of profit, let's turn to the balance sheet. The balance sheet provides a snapshot of a company's financial health, listing what it owns, its assets, and what it owes, its liabilities, on a single day. Think of it like a personal net worth statement. While the income statement is a video of performance over a year, the balance sheet is a photograph. The core principle is simple. Assets must always equal liabilities plus shareholders' equity. This equation is the bedrock of financial stability. On the asset side, we have current assets, resources convertible to cash within a year, like cash, accounts receivable, and inventory. Watch their trends closely. If receivables grow faster than sales, it's a caution flag. It suggests customers are slow to pay and the company might be extending risky credit. Likewise, ballooning inventory can indicate trouble selling products, which could lead to future losses. Long-term assets include property and equipment. We want to see smart investments here, not reckless spending. Another item to scrutinize is goodwill, which arises from acquisitions. If a company repeatedly writes down goodwill, it's admitting it overpaid, destroying shareholder value. Flipping over to liabilities, we see what the company owes. Current liabilities are debts due within a year, like payments to suppliers. Long-term debt is a critical area. As Warren Buffett preaches, the best businesses often carry little or no long-term debt. Too much leverage is risky and can cripple a company during a downturn. The difference between assets and liabilities is shareholders' equity, the net worth belonging to the owners. A crucial part of this is retained earnings, which are the accumulated profits reinvested back into the business. For strong companies, this is the primary engine that compounds shareholder value over time. Several key ratios bring the balance sheet to life. The debt-to-equity ratio tells us how reliant the company is on borrowing. Lower is generally better. Return on equity, or ROE, is a report card for management, showing how efficiently they use shareholders' capital to generate profit. Consistent RO above 15% often signals a superior business. A healthy balance sheet shows minimal long-term debt and retained earnings that are rising in lockstep with earnings per share. This structure reveals true financial strength. But to see where the actual cash is going, we must turn to the truth serum of finance, the cash flow statement. Cash flow is split into operating, investing, and financing activities. Operating cash flow shows cash generated by the core business. That's key. Investing cash includes capex. Buffett notes strong businesses don't need massive capex just to stay afloat. A practical idea: operating cash flow minus capex should be consistently positive. Financing shows debt moves, share buybacks, and dividends. Watch whether buybacks are funded by real cash. If earnings don't translate to operating cash over time, that's a red flag. Green, consistently positive operating cash flow. Green, capex that supports growth but doesn't permanently drain cash. Red, long stretches of negative operating cash despite reported earnings. Summarize: operating cash up, capex reasonable, financing sensible, good signs. Now pull the three statements together into a Buffett-style checklist. Now let's pull everything together into a simple, powerful checklist inspired by Warren Buffett's approach. We'll start with the green flags, the hallmarks of a wonderful business. A key green flag is high, stable gross margins, which signals a durable competitive advantage or moat. You also want to see operating income growing steadily. This shows the core business engine is strong and getting stronger, separate from financial engineering. Another huge green flag is little or no long-term debt. A company funding its own growth is a master of its destiny. Also look for consistent earnings and a healthy return on equity, or ROE. This proves management is skilled at reinvesting profits to generate even more, a true compounding machine. And finally, does the business gush cash? We need positive operating cash flow that comfortably covers its capital expenditures. This is the sign of a self-funding business that rewards shareholders instead of constantly needing more cash. Now for the red flags, the warning signs that tell you to be cautious. Be wary of margins that swing wildly. This often indicates a commodity business with no pricing power, subject to brutal competition. Heavy debt or rising interest costs are a huge danger sign, as debt can cripple a company in a downturn. Also, watch for repeated goodwill write-downs. This is an admission that management overpaid for a past acquisition, destroying shareholder value. Two more critical red flags. When receivables or inventory grow faster than sales, it can mean trouble collecting cash or selling products. And be skeptical of profits that don't convert into real operating cash. Earnings can be managed, but cash doesn't lie. So how do you use this? Scan at least 5 years of data across the three statements for a consistent story. For the income statement, ask: are margins strong and operating income growing? For the balance sheet, is debt low and are retained earnings growing? For cash flow, is the company generating real cash with reasonable capex? The book's approach emphasizes understanding the business quality, not getting lost in complex valuation models. The philosophy is simple: find a wonderful business first. The question of what price to pay comes second. To recap key terms, revenue is total sales. Retained earnings are reinvested profits, the engine of compounding. And operating cash flow is the real cash the business generates. Always follow the cash. Here it is, your one-page Buffett-style checklist. Pause the video and take a screenshot. This is your guide. It all comes down to consistent margins, growing earnings, low debt, high returns, and strong, real cash flow. If you found this helpful, please like and subscribe. Now put it to the test. In the comments, name a company and one flag you found using this checklist. Let's analyze it together. This framework is distilled from the work of Mary Buffett and David Clark. For a deeper dive, we highly recommend their book. Thanks for watching.